Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both the positive and the negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The securities discussed herein do not represent an entire portfolio and in aggregate may only represent a small percentage of any Crescat Strategies holdings. The issuers discussed may or may not be held in Crescat's client portfolios at any given time. This video is not intended to be, nor should it be construed as an offer to sell or a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. So let's get started. As usual, I'm going to talk about positioning in our funds and some macro. Tavi's going to get into more macro, and Quentin will be talking about geology and a lot of our companies' investments. Normally the process is, if there's news on our companies, we will talk about them. So there does have to be news. We will talk about the good news and the bad news, but there does have to be news. So anyway, let's get started. I'm going to be previewing. We have an investment letter that'll be going out tomorrow, so I'm going to be previewing some stuff in there. And there's two main important macro questions that have really yet to be answered. Now that the Fed has signaled that they're going to be lowering interest rates, there's two important questions. Number one, do the leftover asset bubbles of the Fed's zero interest rate policy era, the ZIRP era, do they still need to be unwound or not? And number two, has Team Transitory truly conquered U.S. long-term inflation expectations? Or might Jerome Powell's victory lap speech at Jackson Hole last week have been premature? Well, let's talk about asset bubbles first. And as you can see in this chart here, we've looked at the S&P 500 at large cap growth stocks and mega cap tech stocks in different ways. But this is a new way to look at where we are with large cap growth stocks in general. This is the Russell 1000 Growth Index and large cap growth index. And look where we are. We're still at price to book values that are greater than we were at the peak of the tech bubble in the year 2000. So this is something important to still consider. Do we have asset bubbles that still need to be unwound or not? I would contend that we are in a Mag 7 and an AI bubble right now in the large cap growth segment of the market. Let's go on to the next. This is NVIDIA's price to book chart. So we looked at the overall large cap growth index, well above that 10 times price to book level that we peaked out in 2000. Well, NVIDIA is trading at it recently when the stock peaked out recently in mid-June. it peaked out at a price to book ratio of 68 times and is still trading around 50 times price to book. NVIDIA, of course, is the number one vendor to the hyperscalers, the AI hyperscalers. What are the AI hyperscalers? Well, this is Microsoft, Amazon, Google, and Meta, the four companies that are buying them, that are building the data centers and buying the most chips from NVIDIA. NVIDIA, of course, has the leading GPU chips for AI. They basically have a monopoly on the market, but there is competition. There is competition from AMD. AMD sells chips about half the price of NVIDIA for the same power, and the problem is they don't have the software that has been developed for the industry, and so NVIDIA is enjoying this premium. But there's software coming on, and Intel is going to be coming out with GPUs. There may be some competition coming, but let's just pause that for a second. Let's go on to the next. What's another company today trading at a pretty insane price to book value? Apple Computer recently, last month, peaked out at a price to book of 53.6 times book value, and people, Apple, of course, has been buying back stock, and so their book value has actually been shrinking, but they've been buying back stock at an incredibly rich valuation. Is that really the type of buybacks that we like to see as value investors? Not necessarily, and so NVIDIA is buying back stock now too at an impressive, pretty rich valuation. At the same time as the CEO, Jensen Huang, has been selling about $20 million worth of stock per day. They're buying back 50 billion stocks worth of stock at a very rich valuation. Anyway, Apple has been kind of late to the AI party, and there's a lot of hope out there by investors that they will come out with some new features in their next iPhone that will incorporate more of the fancy AI tools that OpenAI has. ChatGPT will become integrated to some degree. We'll see if that's going to be enough to restart growth at Apple, where the innovation has been lacking for years now, since Steve Jobs has been gone, and growth has really stagnated. And yet the people, Warren Buffett, sold about half of his Apple, by the way, recently. Stan Druckenmiller sold the vast majority of his NVIDIA. These are just some coincident signals. Let's keep going here. So what are we looking at to try to time the cycle for whether we're in a tech bubble kind of 2.0 situation or not? The one thing that we really like to look at is the CapEx cycle. And this is an inflation-adjusted CapEx chart. And so what we're doing is we're looking at the 12-month cumulative CapEx on an inflation-adjusted basis. So it's today's dollars. And we're going back and we're including the whole S&P 500 IT sector and the S&P 500 tech and telecommunication sector. And we're adding Amazon to it as well, because Amazon, should be in one of those two sectors. They put it in retail, but Amazon is, of course, the biggest hyperscaler in building data centers, and they're probably much more like a tech company because of that. So anyway, so what happened during the tech bubble? CapEx accelerated at an unsustainable rate as everyone was spending money to build out the internet, but there wasn't a business model to be able to capitalize on that build out of the internet. And so the revenues didn't come. We'll talk about this more a little bit later. Is that what's happening again today? It kind of seems like it in the AI and in the race to build out these large language models and these data centers. A lot of the companies that are doing this, especially the cloud, well, there's Amazon, there's Google, there's Microsoft, all competing with this cloud infrastructure to attract the people who want to do the AI training and and move their business to the cloud. But is the business model there? I mean, my contention is that Amazon is probably going to beat the pants off of Microsoft and Google in this business, because that's what they're experts at. And I don't, it's not Google or Microsoft's traditional, high margin monopoly business. They're spending a ton of money. Is this going to be like the tech bubble in 2000 all over again? We're gonna find out. Let's go on to the next. So the hyperscalers, who are the hyperscalers in Y2K? Who were the hyperscalers in 2000? Well, some of you may remember, it was AT&T, it was SBC Communications, it was WorldCom, and it was Quest. A couple of those companies are basically gone. WorldCom completely bankrupt, and its CEO went to jail for accounting fraud. I think the Quest CEO might have had a lot of problems as well with the regulators. He may have even gone to jail. I forget, but these were the hyperscalers back then. They were the ones spending the most CapEx on building out the internet, and so we're looking here at CapEx in the bars, the stacked bar chart, and it's the overall aggregate market cap of these four companies that you see how quickly it rose from about $200 billion to over to about $500 billion at the back in 2000. These are not inflation adjusted numbers, so those were the real numbers at the time. Let's tech bubble, tech bust. Why did they bust? They spent the money, but they didn't have a way of building a business and getting a return on that investment. Let's go on to the next. So who are the hyperscalers today? It's Microsoft, Meta, Alphabet, and Amazon. And look at the rate that they have been spending on building out their cloud business. We had there was a hiccup, there was a correction in 2022, but then the AI craze has come on, and there's been even more hype and investment in building out the infrastructure for AI training and the data centers, and so we've had this other huge rally here. The aggregate market cap again of these companies is shown in the red line and on the right scale, and you can see that we've gone from about these four companies combined have gone from about 3 trillion market cap just in 2018 to close to $9 trillion in market cap in today's dollars. Today, is the CapEx cycle cyclical? We believe that we contend it is. When you with this much spending that's going on, it's certainly driving the economy. It's driving the stocks, but is it sustainable? It's not sustainable if they're not going to get a return on that investment. I'll tell you that. So let's go on to the next. Let's just flip back to the Y2K tech bubble. Who were the equivalent of the NVIDIAs back then? Well, there's basically three of them. The three largest vendors to the hyperscalers back then were Cisco Systems, the largest market cap company of its time back then, Sun Microsystems, and Lucent Technologies. So these are the guys selling the equipment to build out the internet infrastructure in Y2K. What happened to their stock prices? Well, what happened when their customers couldn't make a return on that investment and stopped buying the equipment? Well, that was the tech bust. And these stocks collectively, which had gone from about less than 100 billion in market cap to close to $1 trillion in market cap back in 2000, collectively fell about another 80 to 90% in price, in market cap over the next 2 years. Let's keep going. So the second, big question, macro question that I posed at the beginning that still needs to be answered today, that's still yet to be answered. Number one, do these asset bubbles still need, that the Fed has created with the zero interest rate policy for the last decade plus, do these asset bubbles still need to unwind, or are we in a permanent bubble situation, especially when it comes to market valuations for large cap stocks? And then the second question is, has the Fed truly conquered long-term inflation expectations? Like Jerome Powell, claimed, essentially was implicitly claiming like they have. And when he took his victory lap in Jackson Hole last week, why was he taking a victory lap? Well, there was a lot of, some joking about team transitory, and but they clearly signaled that they're going to be cutting interest rates now at the September meeting, and on a path to cutting interest rates, and the market's now pricing it in because they believe they've gotten inflation expectations under control this time with their interest rate hikes. It's potentially the same mistake, that they were making when they were claiming inflation is transitory, but what's going on here? How can he make such a claim? Well, they can make such a claim because of this turquoise line here, which shows the U.S. TIPS break even in the Treasury market. You can buy inflation protection by buying TIPS inflation protected securities. There's 10-year TIPS, and they have an implicit, basically 10-year expected CPI rate that is priced into them. So the market is telling you what it expects CPI to be over the next 10 years, and you can see it's come down to about 2.1%. That's the Fed's target. Get inflation expectation, long-term inflation expectation, down to about 2%, and it looks like they've done it. But have they really? What's this red line? Well, this red line is the University of Michigan Consumer Survey of Inflation Expectations. This is the mean consumer expectation from the survey over the next 5 to 10 years, and it's still up over 6%. And this is the biggest historic divergence between these two series that we've really ever had over the last several months, and it's been widening. Why? Because consumers, believe one thing about actual and true inflation that's affecting them, and CPI, which is a government reported statistic that's traded in the TIPS market, might be saying something else. So has the Fed really conquered long-term inflation expectations by conquering market-based CPI expectations? Or what do people really think about inflation, and how is this going to affect the securities markets, especially now that the Fed is going into easing mode? Important questions. Let's keep going. We contend that we are going into a great rotation period. We've seen it already start to happen here in August. That correction that we had in the market at large early in August. Our global macro fund was cranking it in those days on the short side, up about 6% net. And our long short fund was up about 5% net after those first couple of days of August, when the market was down about 5 to 6%, and that's because we, in those two funds, we're not afraid to short. We have short positions, and we're playing this great rotation on both sides. We believe there is opportunity to short the large cap, overvalued growth stocks and mega cap techs, but then what happened throughout the rest of the month? The rest of the market started to outperform, and especially the commodity industries, especially the mining and metals industries, and And so for the rest of the month, we had a lot of mining and metals industry, particularly outperforming, small cap miners outperforming. And well, this chart here is just showing, this is from Calamos, and it says when the Fed cuts interest rates, which kind of stocks do you want to be in? We believe there is going to be a rotation into smaller cap stocks, into commodity related stocks, and this is just showing, through evidence going back to the 1950s when the Fed is cutting interest rates, small cap stocks outperform large caps and mid caps, and so this is why we want to be in small cap exploration mining stocks today. We have much more support of that. Let's keep going. This came out from ExxonMobil, just put out its big energy report, annual energy forecast report, and this is looking at demand for different sources of energy going out to 2050. And one really important thing to note here, with the energy transition, with renewables, with EVs, with electrification and data centers, we can see the biggest growth areas in the market for energy are wind and solar and electricity. You can see oil and natural gas still growing. Natural gas still highly prevalent in electricity generation. And you can see oil flattening out, out to 2050. But what are the growth areas? Wind and solar, and it's mostly solar. We're going to show you in a minute. And electricity, electrification. This is why we love metals. This is why we love silver, importantly, among the metals, and copper. Of course, we like gold too. Let's keep going. What is the biggest area of growth? This is from the Energy Information Administration, the U.S. agency. Similar data that ExxonMobil is looking at. And solar. Solar is the biggest growth area. What are solar panels made of? Silica, which is turned into silicon, and silver and copper, basically. But 10% of the cost of 95% of the cost of a solar panel is the materials. 10% of the cost of the solar panel is silver. Silver is one of the best conductors of electricity, integral to solar. This is why we love silver, copper, but it's solar in particular. Wind still a growing area too. We need metals for windmills too. Batteries. This is why we love minerals and metals. Let's keep going. So oil. This comes from ExxonMobil's report, and yeah, the demand for oil is going to flatten out with the energy transition. That's just the way it is. And whether you believe it's the right thing or not for the climate, that's where we're going. And but the planned investment to continue continue to meet that demand, even though demand is going to be flat, if the oil companies do not make the continued investment in oil and gas, they're not going to meet that flat demand. And so there's an opportunity for oil and gas commodities as well. That's what this chart is trying to show. That's why we still like investing in oil and gas stocks, the companies that are making the investment to meet this demand. And we do think there will be a favorable pricing environment because there hasn't been the investment with this energy transition. A lot of the investment has gone into other areas. Let's go on. Let's keep going. And this is showing the natural gas. Same chart, basically. Natural gas demand actually continues to increase with LNG, with expanding, and with electric utilities still requiring, still needing natural gas. But it's the same issue. We need to invest in order to meet this demand, even though the demand is flattening and not growing as fast as the demand for things like solar. Let's go on to the next. I'm getting to the end here, so I'll finish up. Look, I showed this one last week. I just want to show it again. It's just really important to understand that in a declining interest rate environment, two of the industries that outperform, or four of them on the cyclical side, and we are interested in the cyclical side because we're looking forward to the next business cycle in this. We think it's a stagflationary environment and a transition that we're going into, but we do want to look forward. So we're looking at the cyclicals that people will start discounting the really cheap stocks that have the high growth coming out, going into this rotation. It's materials, it's industrials, it's financials, it's energy. We're particularly focused on materials and energy because we believe the great rotation is really about rotating out of overvalued long duration financial assets and into undervalued commodities. That's where the demand is. That's where stocks are cheap. That's where the really high growth is. And it's also the most under-owned segment of the market. We don't want to be what's over-owned. Okay. What's under-owned is materials and energy. And this is where we want to be, where the growth is, where the value is, and where the investors aren't yet, but where they need to rotate when they rotate out of the overvalued stuff that's coming down and into the undervalued high growth segments of the market that will be the beneficiaries of the new business cycle. Let's keep going. I'm down here. This is my last slide. And this is just showing this another way, another great slide from B of A. And it's showing, it's showing the great rotation. It's showing the setup for the great rotation, which still hasn't happened yet. We're still in a bubble for tech and telecom. It's over-owned. The money is over-invested, over-positioned, and overvalued stocks in the tech and telecom areas. It's underinvested in energy and materials. This is where the low valuation, high growth opportunity is as we go into this rotation, not unlike we had coming out of the tech bubble. Look at how it worked coming out of the tech bubble. That's when energy and materials bottomed. You can see that left-hand circle with 24% on the lighter blue line. Look at how that line was going up at the same time as the dark blue line was going down in 01, 02. You can have a rotational kind of market where new cyclical growth sectors outperform even as the large cap growth and tech bubble sectors are collapsing. So that's it for me. I'm going to turn it over to Tavi now. Let's keep going.
Looks like there's one more chart.
One more. This is one that Nathaniel slipped in here on me at the last minute, and it's just another inflation chart. Showing, this is the St. Louis Fed's, price pressure, indicator, and it's still been rising. Just another chart, has the Fed really conquered inflation expectations, especially now that they're going to be lowering rates? To something else to suggest that there's still a lot of inflationary pressures out there. And I think this is all the more what's going to make these commodity equity sectors of the market much more attractive. They're so under-owned, so cheap, and have so much growth ahead. This is how we're positioned at Crescat. On to you, Tavi.
All right. Thanks, Kevin. Well, I'm going to touch a little bit on something that was reported today and then dive into what I think it's opportunity here in markets, but also positioning in terms of how I view, the overall macro landscape. But this is a chart that today was reported, University of Michigan, that comes out every once in a while on a Friday. And it was showing that the current economic conditions is collapsing, and it fell again, another decline in this number, as you can see in this chart. You can point to other directions in terms of where prior recessions, where we were, the S&L crisis in the early 90s, the tech bust, the global financial crisis, COVID, and where we are now. But here's a better measurement. If we go to the next chart, this is a true, market-based metric to really try to look at what the conditions are of consumers. And there are pockets of the consumer aspect that it's starting to crack, in my view, and this is one of them. So if you look at car loans, so if you're a lender if you're in the business of lending capital for those who are looking to buy a car, why are you keeping your interest rate higher than the comparable? In other words, the risk-free rate of the government. That usually tends to be the case because you're perceiving risk across most of the consumer credit ratings, and therefore you're not seeing the reward of actually lowering rates to match where the government risk-free rate supposedly is located at right now, and therefore it creates this gap. And as you can see, this gap is actually, it tends to happen prior to other recessions. I guess logically it makes a ton of sense. As you can see, the profile of credit of the consumer tends to deteriorate as we get into the beginning of a downturn. And so these companies are forced to actually protect their butt. So what they do is they let interest rates higher than risk-free rates. So you tend to see the spread between the two. So this is a great way to match. You can see this in mortgage rates too. If you do mortgage rates versus where the risk-free rate is, you will also find another spread here as well. But anyways, this is just to touch on the prior chart so you can see a real metric indicator to show where the consumer cracks are showing. And one of them is in the car or the auto business. Let's go to the next chart. Well, it's a good thing that the Federal Reserve is lowering interest rates to save the economy. Well, that is slightly joke because I guess as you can see on the chart, every single time we've seen, at least going back to the tech bust when the rate cuts period started, was the beginning of a recession. Now, wouldn't it be interesting if we actually have interest rates falling and the Fed committing to declining interest rates, and at the same time we start to see inflation rising, and the Fed has to be forced to ignore that just because it needs to alleviate the pressure on the government to pay its bills? Well, I think that's a very strong possibility here in the markets. Let's go to the next chart. What if this chart right here, if you go to the next slide, and you can see the inflation expectations, begins to actually bottom. So this is just looking at the 5-year break-even rate. For those who don't know, this is where the market tends to sort of expect where CPI will be 5 years from now. And a lot of people will say, I don't care about CPI. Well, the market does, so you should be looking at it at least. And as you can see here, back in the early 2021 or so, during that first spike of inflation, that chart actually broke out in a very significant way. Historically speaking, would be seen as a historical breakout. As you can see there, it took momentum and actually went all the way up to 2022. And now it's actually almost perfectly retesting some of the trollers will say, Tavi, hasn't perfectly retested yet. Just think about risk reward for sakes. I mean, you can see here clearly that we're so close to forming a bottom in this chart. And if you are of that view, you at least, as I said in a prior presentation, I was talking about how in macro, you start kind of putting all the puzzle together. Well, let me give you some puzzles, some parts of that puzzle here in the next chart that can maybe show why inflation expectations could be bottoming. Let's go to the next slide. Well, agricultural commodities is one interesting one. The green line is showing that actually this continues to move higher. So that's the green line. It's looking at a ETF of a basket of different commodities. And you can see the white line, the yellow line is actually food prices globally, not just in the US. And you can see we're starting to bottom, but maybe this is not really confirming that thesis just yet. Let's go to the next chart. So the next chart now is showing the dollar. I actually think this is one of the most inflationary impacts we may see here in the next, especially the next year or so, is this potential further declines of the dollar. And yes, the dollar has rallied in the last 2 days or so, but I focus on the big trend. And I do think that the dollar is structurally showing some very weak signs No, this is more of a technical chart, as you can see here. Now, going back to 2021, I'm going to go back even further in history so you can see better charts. But notice that in 2021, the dollar didn't really create that pressure on inflation. Yeah, that was coming from all sorts of things, the COVID situation or the supply aspect, or commodities were rallying, even with the dollar rallying. All sorts of things are happening. But now, if you think about why is this happening, well, look no further than what's going on with the twin deficit. That's what happens when you have such a large amount of leverage in the system. And at the same time, you're running a fiscal deficit of close to 6 to 7%. And then you're adding another 4% or so of a trade balance, which is the case now. And the trade balance keeps deteriorating. And some people will say, again, the trollers will probably say, well, Tavi, but if you're a reserve currency, you're supposed to run a twin deficit. Yet not a double digit twin deficit, which is the case now. So those things really add pressure on your currency. If we go to the next chart, here's an interesting data, just full disclosure. This chart is a little bit old, and I will show you the updated chart in one next slide. But look at this. It's a Japanese yen. Oh, go back. Sorry, go back. That's the punchline. Go. This one is looking at the Japanese yen non-commercial position. So what is it? So if you go to CFTC, they tend to show you what are those traders in terms of their positioning. Their positioning was extremely bearish on the currency right before the dollar yen carry trade that everyone was talking about, which if you go to the next chart, you can see that spike in positioning right there, the spiking in position that happened right after that. But, in markets, everything looks really obvious in hindsight. And you have to look for those times when you have all the signs aligning before one of those big volatility events. The same thing happened back in the Volmageddon of 2018, even the recent vol event that we had. All these signs of suppression were really clear in my mind. Now, I'm going to show you one currency that shows exactly what the prior chart was showing, which is extreme bearish positioning. Let's go to the next chart. And so now you can see the Canadian dollar. Well, that's interesting. The Canadian dollar, and this is looking at versus the open interest, which is a more conservative way of looking at it. If we go to the next chart, you can see even further extreme. Can we go to the next chart? So now you can see even more extreme bearish positioning here on the Canadian dollar. And would it surprise you if we have some sort of short squeeze in the near term? It shouldn't. Well, the positioning is right there. When everybody is overwhelmingly bearish on something, well, there's only room for people to become bullish now. And so that is when you tend to see those big changes in currencies, not really just currencies, I guess any other asset class. And so I pay attention to those things. And I think that if you're obviously a junior or even a resource investor that has a lot of investments in Canada, well, that's something that is very relevant for you. And in most of the companies running those businesses actually hold a lot of Canadian dollars. Well, that's also interesting for you. If you're also paying attention to the Canadian stock market versus the US stock market ratio, which I'm not going to show here, maybe next week, you can also see that we're probably forming a historical double bottom in that chart. So all these things are kind of like, probably the next domino to fall is, in my view, the US dollar, and maybe potentially versus the Canadian dollar too. Let's go to the next chart. Now, technically speaking, it shouldn't surprise you if we see a breakout. Well, a major move on the Canadian dollar would actually show a breakout from a pretty significant historical resistance that we've seen. We hit in that line many times before, and guess what? Maybe this time is different. Maybe we're going to hit it, and actually we're going to surpass it and start a new trend. That's what happens usually in macro, and it wouldn't surprise me at all. Positioning is certainly giving more conviction to that view, and I actually have very strong conviction that will be the case. Let's go to the next chart, and you can kind of break it down. I'm showing charts from the prior week that are still relevant for this discussion. The euro is very close to it as well, as you can see here. These are all extremely inflationary impacts in the U.S. economy in particular. Let's go to the next chart. The British pound already happened as well, already broke out from those levels. So you start seeing that other currencies have sort of things that they don't play out all at once. You tend to see all these things kind of, some of these currencies are starting to make a move already. These are usually very intelligent investors that start to position early, and others are still lagging. And so you tend to see these kind of lagging effects in markets are very normal. Let's go to the next chart. And now you can see the Brazilian real. Well, that's similarly not as strong as I was showing on the Canadian dollar, but the Brazilian real is also showing some pretty negative positioning across most investors. And it shouldn't shock you if we see the Brazilian equity market, or I should say, Brazilian real appreciating versus the dollar. So this is the basically the punchline for the dollar, the structural bearish view on the dollar, number one, given the imbalances we have in the twin deficits, the fact that the Fed just simply cannot afford having such a strong restrictive monetary policy, and it has to adjust it. As it does, this is going to have, in my view, a very significant impact in currency markets. And so I'm seeing this on top of all these positioning reports that we're seeing from the CFTC. And to me, it looks like we have all the ingredients for something just like the dollar carry trade idea, but on the other side of these other currencies actually rallying significantly. Let's go to the next chart. Let's keep going. Another thing that could create inflation is the wage growth that has been kind of off the radar recently. A lot of people were talking about the wage growth back in 2020, 2021, 2022, and then since then we've been decelerating on that growth. Now, these things are starting to show signs of bottoming. And I think it's interesting because the Fed is basically hiding this card, in my view, that they care about inflation and labor markets, when truly all it matters is that they need to make sure the government can pay its bills. And so, in my view, when I looked at this picture, I think that it would be very plausible to see inflation bottoming in many ways, as I was presenting in prior slides here too. And at the same time, actually forcing the Fed to stay with lower rates. Well, that would be, just thinking from a macro standpoint, would be nirvana for hard assets. Those are the two words that come to my mind: hard assets. Because if you're in an environment where you have to allow inflation to run hotter than expected, and at the same time you have to adjust your interest rate policy, well, that tends to provide a real supercharger environment for tangible assets like commodities. Anyways, let's go to the next chart. Natural gas. Somebody on the commentaries asked me a question about natural gas specifically. Look, I do think there's a gap between natural gas prices in the U.S. versus other places in the world that looks very attractive. I think that's very not as easy to kind of express that view in markets. But this is an interesting way to do it, is looking at the natural gas price itself here in the U.S. We're seeing the electricity consumption and all sorts of things really happening in terms of the spike of the consumption in the U.S. because of the AI revolution and all sorts of things that are kind of driving that demand. And natural gas can be, in my view, a very important alternative as a cheap source of energy for now, that can potentially actually also ultimately drive prices much higher. So when I look at not the positioning, but the actually forward curve for natural gas, which basically shows the difference between forward contracts that are much further out versus, or 1 year out in this case, versus the next month contract, you can kind of see that when we have the contango, in other words, when the much further out contracts have a much higher price versus the short-term ones, you can see that those tend to mark very important bottoms in this commodity. So the fact that this hasn't really worked immediately doesn't make it not an interesting idea. So I think my view is that there is a potential where we can see much higher natural gas prices, and this forward curve is, to me, potentially as well a leading indicator for that the commodity is trying to form a bottom, and that can add on inflation one more time. Let's go to the next chart. All right. Well, this is a very important quote from John Templeton, which I think some people should live by that quote if you're in markets. Bull markets are born in pessimism, they grow in skepticism, and they mature in optimism, and then die in euphoria. Well, that's an interesting thing because I immediately start thinking about what are in this stealth phase or awareness phase that is basically in that takeoff environment. Let's go to the next chart. I'll show you one that I think it's in that place. Well, Brazilian equities, if you look at the median PE ratio, and why is it so difficult to, that whole idea that seems so simplistic to buy low and sell high? The main reason for that is because people come up with all these ideas of why, multiple ideas of why an asset that is cheap for a reason. And usually it is true. I mean, always an asset's cheap for a reason. Very rarely you're going to see something happening that intrinsically there's no issues in that asset, and we're just seeing all the positives. Usually there's always some hair, but the whole point is that hair is mostly reflected on the historically depressed multiple. And I view Brazil and the Brazilian market in that way. And here you can see the comparison of a PE ratio. This is just a simplistic way of seeing this. The largest 10 companies by market cap throughout history. And you can see the median PE ratio of this market. And you can see clearly back in 01 and 2002 and so forth, when we had a secular bull market for this. In fact, the Ibovespa, I've said this, the prior presentation, the most boring way that people would buy Brazilian equities would be buying Ibovespa. Went up 18-fold during that time from the early 2000s all the way to 2011. Now, these are the types of returns. I call these asymmetry. It's buying something cheap that has asymmetry to the upside. And so, obviously there's no guarantees, but that's the type of setup you're looking as I think a macro investor, identifying some those value. This is value 101, value approach 101, looking for those value opportunities, which I guess value approach is so out of fashion that very few people actually know how to do it. But nonetheless, I do think that never dies. You're supposed to be looking for those opportunities in markets all the time. And I think that Brazilian equities present some of those today. And so, for those that are complaining about Lula and all that, yes, that is not a positive factor for the market. Or what's happening in terms of the issues today, in terms of what the state is going after, Twitter and all those problems that are happening now with Elon Musk. If you've been hearing about it, all those things to me are progress. I mean, they've always existed. This idea of having control over the media in Brazil has always been the case. The fact that we're talking about it, I call it progress. It's great. I think this is absolutely great for the country. And so I hope we continue those discussions and hopefully improve those things. Nonetheless, I'm not here to talk about politics, but really about the opportunity of buying something cheap and selling something later that is overvalued. And I think the Brazilian equities are, in an interesting setup in my view. Let's go to the next chart. I'll keep this fairly short now. And you can see here, another way to see it is as Bank of America shows this charts of earnings revisions. And we're starting to see this pick up in Latin America, in emerging markets overall, in terms of their earnings revisions. Well, that's interesting because, fundamentally, you want to see that improving as well as a way of becoming a huge part of the support of this idea. Let's go to the next chart. I might be almost done, if not done. Can we see the next chart? I'll go here. All right, well, not done yet. So here's one. I think this is another way of thinking about, that bull markets are born in skepticism and so forth. Well, think about the gold mining industry. Is there anything that people are more skeptical about than a gold mining company? I would argue that it's probably worse than even coal companies or cannabis, or call it, it's definitely in the category of one of the most skeptical things out there. And so that's when you want to be looking at these things, especially when you have the tailwind of the macro environment with gold prices at record levels. And you start looking at technically in this chart, if you look at the very top of this chart, well, it already broke out on a monthly candle, which monthly candles tend to have a much stronger signal, just like quarterly. And at the same time, if you look at the capital spending, which if you research natural resource companies over history, one thing one really needs to pay attention to is when companies are spending like drunken sailors. Well, that happened in 2011. Where are we today? Look at the capital cycle. The capital cycle for the miners is one of the most historically depressed periods we've seen in history, despite the fact that gold prices are at record levels. And so, to me, this does not show any signs of frothiness at all. In fact, it's the other way around. And all this skepticism is still happening, despite the fact that we're seeing improvements even in mining company shares now. And so, I think this is a really interesting setup. If you ask me if this is the end of a move, no, I think it's a very beginning of a move. That's just my view. And the main reason for that is because we haven't seen anything. We haven't seen the true M&A cycle. We haven't seen CapEx spending like crazy. We haven't seen even the real improvement that I think we'll see in most of these companies. They're improving. Fundamentally, they're looking better, but I think we're going to see a lot more. And so anyways, these are the types of opportunities that we can see unsettling here in the following years. Let's go to the next chart. I think I'm close to done. Energy is another one. It's not, historically depressed in terms of the prices, as you can see in this chart. But if you're the view that you can see something like we saw with the inflation starting to bottom, it's hard to believe energy is not going to participate on that. Well, I'll talk about natural gas. I have a view on oil as well. But I do think that if you look at the price of energy, and just look at historically here too, there was a time when oil actually peaked back in 07 or 08 during the global financial crisis. You can see that there was not much of a consolidation period at that peak. It was a very steep increase and then a steep decline. Look at back in 2014 or so, when we also had the kind of shale bubble period. Also was a steep increase and then a steep decline. And today we're actually seeing sort of like a pennant forming, a bullish pennant. And in my opinion, it's very likely gold was doing exactly the same thing, not too long ago. I think we're probably in the process of seeing something similar for energy equities. Anyways, let's go to the next chart. Think I'm done. No, one more. A question I posed to folks, when I was looking at this chart, gold to treasuries ratio. If you're a central bank, what would you rather own? You got to ask yourself, as an investor, I understand there are some benefits of owning a yielding asset like treasuries. If you're getting 4 or 5% yield, there's nothing wrong with that. Gold doesn't yield anything. Now, if you're a central bank that is in the desperate need to improve the quality of your reserves in order to improve also the stability of your monetary system, especially in a world that we're seeing all this instability in monetary systems today, and the fact that hard assets are really challenging fiat currencies nowadays. I would suspect that they would pick the former, not the latter, in this ratio. And when you look back in history of the gold to treasuries ratio, and I'm looking at the Bloomberg U.S. Treasury total return index, so assumes also the yielding aspect of this instrument, you can see that back in the 70s or so, we did see a large increase, but we just haven't seen enough yet. In my view, this is just the beginning that ratio is likely to perform much better even further in the following decade. So to me, this is the main focus when it comes to another macro trend for the next 5 to 10 years. Quentin, I think this is my last chart, so I'm going to pass it on to you.
All right. Thank you, Toby. Okay. All right. This week, we don't have a lot of time left. I want to try to get through all our updates before the hour strikes. So I got about 30 minutes. I don't have a big, long boring geology lecture. Okay. But I'm going to give you a little snippet about what I plan to do next week. I'm going to talk about Nevada, and I'm going to give a history of gold mining in Nevada. It'll hopefully be interesting. I'm going to try to couch it in a way that people can see how a massive gold district on planet Earth unfolded. Okay, it took many years, but we need another Nevada, if you will, in the gold mining industry to help sustain this industry for the foreseeable future. And I think we're seeing that unfold in the Yukon. So I'm hoping what I present next week will give people an impression of how a gold district gets established. All right. So, but this week we're going to dive right into updates. Go to the next slide. We are going to talk about news that's come out over the past week. Quite a few news stories. Some giving updates, some talking about started drilling, some talking about kind of previewing what's to come in exploration. You know, things are perking up. We're starting to see more companies with a bit more money and more activity. And it is getting towards the end of the season, so I expect a lot of news flow out of certain companies over the next few months. Let's go to the next slide. Okay, this week, Snowline put out an update both on the valley drilling that they're doing. This is drilling that is really starting to see some sizable increase to the valley deposit, as well as their infill. Okay, so they've got both going on. But then they also talk extensively about exploration they're doing. They're testing multiple new targets this year, and I think they're seeing some very exciting results already. I'm going to start here by talking about the headline hole that was drilled, 77, which was 1.61 gram per ton gold over 435 meters. Now, you say, oh, gee, that's, it's in the valley deposit. Look, this is a big offset. In my view, this hole tells us something. It tells us something that is good. It tells us that the deposit has plenty of room for growth. All right, so we're going to talk about that, and then we'll talk about the exploration. Notice down there at the bottom bullet, they have assays pending for 21,000 meters across 7 targets. Okay, so there's drilling still happening. So again, they have a lot of news coming over the next few months. This is quite exciting. We'll go to the next slide. We're going to look at the drill plan map for Valley and see where the 2 drill holes that they announced in this release are located. Hole 76 is kind of right in the middle of the guts of the valley system, and it goes across the top and carries out into the wall rock, the gray rock that you see there, off to the southwest. But this hole 77, which is up towards the top, the color of it is at the top right of this image. This one is really super interesting. Okay, this hole is a step out, so they've stepped back. It's one of the furthest furthest collars to the northeast that they've drilled on this property, and it hit a huge whack of gold. Now, before I move forward, I'm going to ask Kevin and Tavi to look at this image. Okay, look at that image, and this is the beauty of looking at the detail. If you're a retail investor, look at this image. Tell me what else do you see in this image that might be telling us something?
Oh, man. Quit, you put me on the spot here,
I'm
man. I'm not a geologist.
I'm putting you on the spot. I'm putting you on the spot, darn it. Okay, you got a lot of pending assays. Okay, a lot of drill holes with a blue dot. Okay. Look at the little yellow stars there. What are those, or yellow dots? What are those?
Visible gold.
Correct. Now look at the drill holes that don't have assays yet. Okay, don't have assays yet, but they've noted where there's visible gold, and look at how much there is, and look at where it's distributed. Yeah, do you think this thing's going to grow? Yeah. There's a lot of holes with a lot of gold in them. And this is what I love about Scott. He always has something in there that kind of, you gotta kind of go to that next level. You gotta dive a little deeper into what they're trying to convey here. That's an important detail about that image. Okay, that image, those gold dots tell us there's a lot to come. All right, so let's go to the next slide. Okay, the first thing we're going to do is look at the cross section that encompasses both those drill holes that came out. You can see the 2 holes. 76 did pretty much what it was expected to do. All right, we'll call it a bit of a step up, but more of an infill hole. It simply shows us clearly that that high grade is present near surface and that there's a long string of lower grade mineralization below it. Okay, but this whole 77, look at that puppy. That thing is a big step out. In fact, there's gold all the way to the bottom of that roll. It's basically mineralized from the very grassroots all the way to the end. There are some higher grade zones. Yes, in fact, they're higher grade in areas where right now the block model doesn't really reflect anything. In fact, it's outside of the pit towards the bottom there. This hole tells us there's a lot more tonnage to be found here. And if you can imagine, that black line, that jaggedy black line is the pit that they have currently defined. That pit's going to have to be expanded, probably significantly, to catch that. And it's still open to the east. Don't forget that. All right. So this is exciting. Now, before we go on to the other updates, I'm going to show this thing in 3D. I always like to do a little bit of 3D demonstration if I can. I can't help myself. Okay, we're going to share our screen. Hopefully you can see this.
Not yet.
You're not yet?
Yes. Now, yes.
Okay.
Nope, gone. Oh, back. Okay.
I'm not sure why it's being spastic, but I'm going to zoom in a little bit so we can see it better. In fact, I'm going to click it right there so we're centered. Okay, so there we go. All right, so this is effectively all the drilling at Valley in one model. It allows us to see what's going on much more clearly. And we're going to take a look. We're going to look at that hole, which is 77, and this hole real quick. Okay, so underneath here, hole 76 did pretty much exactly what we would hope it did. It's this guy right here, okay? And there's a high-grade interval at the top and a big long string of lower grade below it. But it's this hole back here, is really encouraging. Okay, it's this guy right there. That is hole 77. It is mineralized from the very grassroots all the way down to the bottom. It's open. Okay, so yeah, there's probably more gold down here. You can see some other holes kind of either, I think those are behind. Yeah, they're off in the distance. But they also suggest there's gold down below, right? And then some of the holes that come this way suggest there's gold. Look at this guy right here. There's gold clear out here. We have a lot of rock underneath. Sorry, I'm bouncing around, but underneath this area here that still has yet to be defined. If I spin this around, you can see right away that, basically let me expand my window here a little bit. That we have a lot of volume that can be added. Okay, I'm going to zoom out a hair. So underneath here, it's wide open, quite frankly. Yeah, that's really significant. I think that as they drill more, I wouldn't be surprised if they find there's actually some major extensions yet to be found. Okay, sometimes when you look at something like this, you think, it's okay, it's getting close to being drilled off. But remember those yellow stars that we saw on the previous map, okay? In fact, I think they show up in this image. Look at all those yellow stars. Look at those. Look at these holes. Look at this hole. Look at that one. Okay, there's a lot of holes that are going to be back underneath here that have long strings of gold mineralization, right? So this thing is growing. It's growing, and it's growing in the right way. These guys are doing a fantastic job. They always do, but it gets better. Okay, so now I'm going to go off of that, and we're going to go back to the deck.
You've always said, Quentin, that you thought there was more gold out in that direction for a long time.
Yep, underneath there. Yep,
finding it.
Absolutely. All right, go to the next slide. Now we're going to talk about their exploration work. Okay, so they've been drilling at this target called Aurelius. I've tried to tie a little blue line over there to show you where it is. It's actually northwest of Valley, a few kilometers. And it is a similar target in that it's a reduced intrusive, okay? So we have the same style of mineralization, albeit a bit higher level in the system. All right, they're seeing a lot of breccias and stuff, and I talked about this a couple of weeks ago when they had their last news release. Now, this week, they mentioned a couple of things that really caught my attention. First of all, they see visible gold. Okay, this gold looks a lot like the gold we would see at Valley. Okay, so there's that. I mean, that box is ticked now. I think that's very encouraging. But here's the other thing that catches my attention in the news release. They're expanding the drill program at Aurelius. Okay, once again, you got to kind of take that, read a little bit deeper into it and pull that information out, because it's a classic Scottism, in my view. Scott likes to hide things in plain sight. But he basically said that they see, they're encouraged enough to drill additional holes at Aurelius. I find that very encouraging. Okay, so stay tuned. Maybe this is another discovery. It could be very important. Let's go to the next slide. Next one is Sydney. I think this one is particularly encouraging. And in my view, this one really gets me like all tingly, because it looks a lot like the original discovery at Valley. A lot of sheeted veins. The photographs that the companies put out of the country through here with the granite and the just innumerable little quartz veins looks like the spitting image of Valley. Very encouraging. Okay, this system is due south of Valley. Again, I've tied blue lines in there to show you where Sydney is located. It's on the Cynthia property. Notice in the top row there that they've seen visible gold with bismuth and tellurium minerals, just like they do at Valley. So the gold is the bright yellow. Those little specks of bright yellow, that's native gold. Free gold, if you want to learn more about free gold, look at my videos from the last couple of weeks. I talk about it extensively. And then we have that gray stuff, that kind of bluish gray stuff around it. Those are bismuth and tellurium minerals that are very commonly associated with gold in reduced intrusive systems. Okay, so they're seeing the same thing that we see at Valley in the quartz. And yes, those are magnified. Okay, just for a sense of scale, those are highly magnified. Now, they drilled 3 holes here. You can see the plan map over here in the lower right. And the three holes have logs of the amount of quartz vein per meter. Okay, and if you look at the colors, the pink, red, orange, those numbers are very similar to the density of veining that we see over, guess where? At Valley. Okay, they also locate visible gold. So it wasn't just like one spot with visible gold. There's multiple spots. Sometimes the gold can be, of course. Am I flashing up on?
Yes.
Did you lose? Oh my gosh!
I think you're
Where
back
did I
now.
cut out?
I think you're back. No, just two seconds, man. You're fine.
Okay, so we see visible gold like this in reduced intrusive systems. Sometimes it can be really small. In other words, it's pretty darn hard to see the little specks. But it can still be high grade. Okay, there's lots of examples of that. Other places like Valley, you can see it fairly readily when you look at the core. I was able to see it last year when I went up. All right, but here at Sydney, it'll be quite exciting to see what the assays tell us, because they are seeing the quartz veining in all of these holes, and the quartz veining is the key in my view. It's what hosts the gold mineralization. So Sydney looks very, very encouraging. Let's go to the next slide. Okay, they've done quite a few holes at Jupiter. They got assays for 2. The results are not quite as strong as I thought maybe they'd see in the first round, but they're not bad either. Okay, the top hole in particular, if you look over here, first of all, you can see where Jupiter is located. It's north of Valley. Okay, this is a target. It's completely different geology in some respects. It is in an orogenic gold system, so it's related to metamorphic fluids rather than reduced intrusions. That said, you never know. There might be an intrusion lurking around here. Okay, but the holes that were drilled 3 years ago, very encouraging results, usually multiple hits of veining and high grade. In the 2 holes that they released this week, both holes did hit mineralization. So I'm not saying this is a bust or anything. One of them was somewhat low grade. So you can see the 2 holes over there on the far right. They're kind of coming off the same pad. They're going at different angles off the same pad. But the upper one actually hit three individual quartz vein lodes, veins that are not bad. Okay, and in aggregate, if you add up the gram meters for all 3 of those, you get about 67 gram meters. That's not bad. It's not, it's not the 100 gram meter we like to see every hole, but every hole can't be a winner. Doesn't bother me too much. There's a lot more drilling these guys have done here, and I think they're going to have lots more results. And I think some of the results to come actually have those specks of EG that we saw in the news release a few weeks ago. So stay tuned. I think there's more good news coming. Anyway, so a really good update out of the company. Valley looks like it has plenty of room to grow, and we have 3 targets here, 2 of which are brand new, Aurelius and Sydney, that might be new discoveries. And then we have some good news out of Jupiter. We'll say neutral news, but not bad news. All right, let's go to the next slide. We're going to have to scoot along here today because the market's going to close pretty quick. And I want to get these through. All right, so Western Alaska, this is the bulk of their news for this year. They went up in late May, started drilling, had about enough money to be dangerous, but they had a relatively fruitful, in terms of meters, a relatively fruitful campaign. I'm going to show their table of drill holes here in a second. But this news release really sums up probably what's one of their best intervals for the season. I don't know how many more assays have yet to come, but they, this is a bit disappointing. 4.6 meters of 1.3 gram. There was a short interval of higher grade, about 0.18 meters of 12.5 gram. Now let's look at what happened. Okay, let's go to the next slide. Okay, this is a long section across the property. It shows where they targeted some drilling this year. They drilled 3 different areas from what I can see. They drilled some. It's a little vague. The news release didn't have all the details, but I think they drilled some at Water Pump Creek. Maybe I'm mistaken. They drilled some in the LH zone, which is the fault offset portion of the CRD system, and then they drilled this Warm Springs zone, and that's actually where they hit the mineralization, was hole 4 in the Warm Springs zone, which is over on the left. That's actually closer to the Illinois Creek mine. So you have 2 CRD occurrences here, the Illinois Creek mine and Water Pump Creek, with a lot of targets between, and they tried to start testing these areas between. Unfortunately, they did not hit a home run. Disappointing, but that's the way the cookie crumbles sometimes. Go to the next slide. Okay, this shows a close-up of the mineralized interval they did hit. It shows in particular that 0.18 meters, 12.5 grams. You might say, well, that's not very wide. No, it isn't. It's not very wide. But I think what we can take away from this is that there is potential. Imagine if somewhere nearby here, they hit multiple meters, like 5, 10, 15, 20 meters of mineralization like this. We'd be singing a whole different story right now, okay? So what does this tell us? It tells us the grade is there, okay? This system can make good, solid, high grades in gold in this case. There was also lead and zinc and so forth, but in gold in this case. And that somewhere nearby, I would expect to find, just like at Illinois Creek, which is not far away, I would expect to find big fat intervals of this stuff. Unfortunately, they don't seem to have hit it this year. Okay, is it the end of the world? No, but it means they're going to have to come back and give it another go. All right, go to the next slide. All right, at the LH target, this is the one, the fault offset of the Water Pump Creek target. They drilled 4 holes, and their interpretation of what's going on is that the CRD mineralization, it must be a bit deeper than they actually targeted in these holes. They did not hit big intervals of lead zinc like we saw at Water Pump Creek a couple of years ago, but they did see a lot of the alteration and so forth that one would expect around a CRD. And they say, look, we're going to have to come back and give it another go at a later date. So the LH target is still a high priority, but they didn't hit it anything big time this year. Now, down there at the bottom is their drill tally. There are more assays. I think I've got my companies mixed up. They have more assays coming. Okay, so the drill program was completed just a few days ago, total about 4,200 meters. The LH zone, the 1,347 meters they drilled there in 4 holes. They don't really tell us much more, a bit of Gaussian was encountered in some of the holes. What will that tell us? I don't know. I don't think they saw any big lead zinc numbers. Warm spring zones. Okay, we saw what hole 4 has. Maybe there's some surprises. Look, you never know with these guys. Okay, with Kit in particular, I think he likes to keep stuff close to vest. Maybe they have more news coming. Okay, so down there at the bottom bullet. This is what we're gonna cling to here. Assays results pending for all holes except IC 24004. Okay, so we'll see. Maybe they have something more coming up. Don't forget Beaver Creek's coming up. Oftentimes, the company likes to put out news right before Beaver Creek. Never know. Let's go to the next site. Okay, Rackla. About a week or two ago, I talked about the disappointing results that they had at Hit and Peak when they drilled. Didn't see what they liked. But one thing I know about Simon is he's a well-seasoned explorer, and he pivots hard. Okay, what does that mean? Well, when you're an exploration company and you can see the main targets you're testing aren't quite panning out like you hoped, you look around and do some work. And once you identify something that could replace those targets, like generate another stream of targets, you go after it quickly. And that's what they've done here. So they've staked this new, what they call grad property. It's on the Northwest Territory side of the mineral belt here. This Rackla or the Tombstone belt, and they don't quite specify exactly where it is, which is interesting. But whatever. Anyway, they do confirm though it is a reduced intrusion type system. Okay, so they have a new discovery. Let's learn a little bit more. Let's go to the next slide. This image shows you the map of the Tombstone Gold Belt. They're way over here on the right-hand side. If you look where black and flat are, those aren't this target, okay? But they mentioned in the news release this zone that they've recently staked, this grad zone, is near Cantung. So it's somewhere in that neighborhood. They're not telling us exactly where it is. Why? Because they probably don't want to disclose too much to the market just yet, because it looks like it's going to be very exciting. Let's go to the next slide. Okay, so they did some sampling. These are basically rock chip samples. They went along the contours of the mountains, and they did rock chip sampling. And the news release is really centered around those two pink dots down there at the bottom. The gray dots, notice they have rock sample pending. In other words, they have assays to come. Be anxious to see what numbers come out of the rest of these samples. But when they got these assays, I think they were jumping for joy. Why? Because look at the next slide. Go to the next slide. Okay, let's see. Yeah, there we go. Okay, so you can see the two samples that ran high grade. One was 92 grams, guys. Crazy. The other one was 16 grams. Very good assays. That mountain is entirely granite, okay? What they're showing in this little inset photo here is a sheeted quartz vein. Okay, so there are veins that you would expect to see in a reduced intrusion, and there's good gold in them. 92 grams. Like, that doesn't fall out of the sky. So let's hope to heck we see more numbers like this when they get the rest of their assays back. And let's see, we hope we see a target emerge out of this. The fact that it's all outcrop and you don't have a lot of glacial cover and till and stuff, I find really encouraging. It means, yes, this is the source of the gold. So this looks like a really, really attractive new target for them. I don't know if they can drill it this year, but let's hope they get good numbers out of these rock samples that are coming. Stay tuned. Let's go to the next slide. Okay, Novo. We full disclaimer, I'm co-chairman at Novo. We drilled the Nungiri North project once again. This is a follow-up drilling to follow up on some successful drilling we had about 7 or 8 months ago. We did get some pretty good numbers out of this. 13 meters at 2.7 grams, 11 meters at 2.2 grams, 17 meters at 1.9 grams. We had some locally high grades within that. You can see the sub-intervals listed there too. Very good, gold numbers. Okay, let's go to the next slide. Let's do a little bit deeper dive and see what these mean though. Okay, so the one thing we've discovered is that Nungiri North is quite a bit bigger than we originally perceived. The original drill program in 2023 is just a small part of a much longer strike on this system. Our team decided to scatter holes across the overall strike of the system. So they drilled some to the east, to the west, and then along this Estrid fault, which kind of cuts through the whole system. All right, let's go to the next slide. The first thing that they saw was that they can now plot up through the drill results we've got. They can plot up the continuity along the gold mineralization along that main body. Okay, and that's good. I mean, there is a deposit here. In fact, I would say, you know, there's, you know, probably a resource of some sort that can be put together once more drilling is done. You know, is it huge? Is it like millions of ounces? No, it's not. But it's you know, there is a discrete body of mineralization here. It looks like stack lodes. All right, how many more there might be, we don't know. But this drilling tells us there's at least 2 high grade lodes here. Maybe where some follow up. We're deciding that right now. But the one that really jumped out at me was this Estrella. Go to the next slide. All right, we drilled, there we go. Okay, we drilled a scattering of holes along that the Estrid fault, and we did hit some very nice numbers there. 13 meters at 2.7, 11 at 2.2, 2 of 6.3, 17 of 1.85. These are numbers that probably do need to be followed up because we only sprinkled a few drill holes along that structure, and we're seeing nice thick intervals of pretty decent grades. This isn't like 1 gram stuff. This is, you know, 2, 3, you know, up to 6 gram type stuff. This is encouraging, and it's certainly worthy of some follow-up. So stay tuned. Let's go to the next slide. Fathom Nickel put some news out about soil work they've done up at Galkager Lake. This work they did really expanded the footprint of the system. I think when you see this next image, go to the next slide, you'll understand what I mean. Okay, the soils, this is data they've gotten in from soils, and in particular nickel, shows a very well-defined discrete trend going through from southwest to northeast through the property. It's a subordinate trend off to the northwest of that. But look at the nickel values that are outside of where they've drilled. The Galkager deposit, where they've drilled most of their holes, is a very, very small piece of what is clearly a much, much bigger system. Okay, so I think this information is going to help the company develop new targets, refine their drilling, hopefully find that center of gravity on the property. Look at all those pink dots to the northeast of that area they drilled. There's a whole string of very continuous high-grade nickel through there. That's encouraging. Okay, so these guys have a lot more work to do. Let's go to the next slide. All right, Cantex put out the briefest news release I've ever seen in my lifetime. It has about 3 sentences in it. I don't have enough information out of the news release to really put too much together about it, other than they talk about some results in a copper-rich part of the targets that they have at their North Rackla property. This property is what we call a broken hill type. It's basically a metamorphosed sedimentary exhalative deposit, SEDEX deposit. And SEDEX deposits can have high copper in them in places. Many in Australia do. So it's not too surprising, right? Now, the main target has been silver, lead, zinc, and germanium. But this copper-silver mineralization that they've encountered in these holes does look quite interesting, somewhat shortish, but modest intervals. Like we have 14 meters of 0.86% copper. The one above it is short. It's just 2.9 meters, but it's 4.5% copper. So interesting numbers. There's clearly more going on in the property. Now, if you recall, they decided to terminate their project or their drilling when there was uncertainties around after the Victoria Gold issue. In this news release, they have announced that they've resumed drilling, so they're back in the saddle, back drilling, and hopefully they're going to get some more holes out, including ones on their silver, lead, zinc. I don't know what they're doing to follow up on this, and I really can't even tell you much more than what I've just told you, because they don't have much in their news release. But interesting results. Let's go to the next slide. This is just a map showing you. Look, if you look at the size of that property in the lower right, It's huge. And then you look at the size of what they just tested. It's like a pimple on the rear end of an elephant. Okay. Like there's a very, very small area that they've tested here, and they've got good numbers. What does it mean? I don't know yet, but I find it interesting that they were able to rock up and hit some pretty good copper numbers on the first go in a brand new area. Let's go to the next slide. Okay, Kuya, this is really a story about what's to come here, because Kuya is back to drilling at their Silver Kings project in Ontario. They are very, very heavy into the science of exploration. So they like to do geophysics and stuff. And in this case, they have done IP chargeability and resistivity to see structures where silver might be hiding. Okay, so they did this survey to identify structures. In particular, this is I can't remember the name of the target. It's down there at the bottom, Frontier Northwest target area. I think this thing has done a pretty good job of identifying the overall trend. Clearly a linear structure in there, trending northwest. You can see in the bottom image they have a little target one where they have a mention of the previous results, silver results. Okay, so we know this is really showing us something real here. And now they know exactly where to chase this thing. They know where along strike to put the drill and test this thing further. Now, they had one more image in their news release I want to talk about. So go to the next slide. This is an image showing historic maps of underground. So we're looking at long sections of the silver veins. And what they're trying to do is show you that when they stoped the veins, when they actually produced ore out of the veins, there were these discrete shoots, high-grade shoots that developed. It's pretty typical of any vein deposit. But that's the kind of geometry we're looking to have. Okay, so they're saying on that structure on the previous slide, they would expect to have multiple high-grade shoots. The high-grade shoots are probably going to have a vertical profile of maybe a few tens to even a couple hundred meters, something like that. But once they figured out this periodicity, it's a very regular pattern. They think they can kind of lock and load. They think they can nail this thing every time. Okay, that's very important. Let's go to the next slide. Okay, Hannon Metals. Look, there's no huge results in here, but there's a couple things I want to bring up about this release. First of all, this is just announcing that they're going to do an extensive geophysical program at their Valiente project in Peru. It's on the east side of the Andes. This is a brand new porphyry belt that they've discovered, and they're being very aggressive with it. I like to see this. I did talk to Brent Cook about 5 days ago, and I asked him point blank, I said, what's your favorite story out there right now? He said this one. He's watching this one closely. He thinks that these porphyries, and I think he even said he went down there. Anyway, he said he thinks these porphyries could be something new and really something potentially world-class. Okay, it's exciting to see a brand new greenfield project like this emerge. Very hopeful. Go to the next slide. There's a bunch of highlights in their news release. Mike Hudson always writes very clearly what they're doing. Okay, so he goes through the plans for geophysics. I don't want to sit here and ramble this off, but I want to draw your attention immediately down to the bottom. Drill permitting. Okay, they expect to be granted drill permits by Q4 2024. Now, in Peru, it used to take you forever. It used to take you a month of Sundays to get your These guys, look, in Peru, they're starting to move faster, granting permits to exploration companies quicker, and it looks like they could be in a position where they'll have a drill story out of this by late 2024. That's great, because this could be a really, really exciting story that evolves over 2025. I think this could be a major discovery type story. Let's go to the next slide. And on that note, there's one thing I realized when I sent the deck. Sorry, guys, I overwrote my SK slide. I just realized that because I had an SK slide. Look, SK had a news release out here this week. I apologize that it got booted. Didn't mean to. But it talked about the end of their field program for 2024. It wasn't much of a program, but it was in some respects. Okay, so we hired Ken, and I'm a director. Okay, for disclosure, we hired Ken McNaughton, who's very famous for his work at Bruce Jack in the discovery of that fantastic high grade deposit very nearby SK. Okay, anyway, we hired Ken and his team to do some work here at SK across their property this summer. They are crackerjack prospectors in the sense they like to go out and do rock chip samples, very aggressive at that. And they took an absolute ocean of them. I think they took like 300 or 400 samples. And we are waiting on the assays from those. We expect to have those in the next couple of weeks. And I have a call scheduled with Ken mid after the shows. I think after Beaver Creek, to go over the results from those, and I would expect we could put out some very exciting news out of SK, not in the not too distant future. He seemed pretty excited about a lot of the things he saw. Okay, last, everybody and their brother's been emailing me about Condor. Like, what are you going to do with Condor? I talked about Barksdale. I'm on the board there now, and we got our plans laid out, and we're going to have some news about drilling here shortly, blah, blah, blah. Okay, but Condor. Everybody wants to know about Condor. I'm going to give you a little snippet right now, a little tiny taste. And you're going to see that Condor is going to quickly evolve into a very exciting drill story on multiple fronts in the very near future. Go to the next slide. Okay, we are going ahead and permitting the East Putumayo area. This is the massive alteration center that you see in yellows and oranges. We had the DIA, the small permit to cover the West Pajingas that you see there. We've expanded that, and we expect to have that in hand momentarily. Okay, so that's going to be a big deal for us. We will be able to drill effectively anywhere across the greater property. That's huge. So Putumayo is going to come roaring back. Go to the next slide. At the same time, we've been working diligently to move Huaynak Punta. Huaynak Punta, it's a bit of a hard word to say, but I've learned how to say it. Is a CRD system. It's a carbonate replacement type system that has exceptionally high grades of silver. Okay, it's not really highlighted on the website so much, but Chris Bunzik, who's the new CEO, has been doing some promotion. Has been trying to tell this story. I'm telling it now. Okay, too. I want to help here. This is an exciting story. It's basically a CRD system around. I think it's a Miocene intrusion that's come up in a very robust carbonate package, carbonate rocks that are very reactive. And it generated bonanza grades, kilos, multi-kilos. Look at that, 4,000 grams, 3,000 grams per ton CRDs. And there has been artisanal mining, going way back in time here. But now we're gonna give this thing a big test. Okay, this could turn out to be a very interesting discovery. So there's another one, Putumayo, Huaynak Punta, and boom, bring up the third. One more slide. There we go. Okay, Cobre Orco. Okay, so this is a property that again is not really highlighted so much yet on the website, but a few months ago, in fact, before I started on this director again. They signed a deal with Teck to earn in on this property. This is a big boy property. Okay, this is a massive porphyry skarn system, and Teck is going to be earning in. They've got some pretty aggressive commitments they have to meet, but this is Ever's favorite porphyry target. Okay, hands down, and you can see that the work they've done here recently is really starting to highlight the magnetic skarn complex around the porphyry. It's that donut effect, okay? The porphyry's in the interior, and then you have this massive skarn, like a ring around it, like a dog collar around the thing. This is a beast of a target. Okay, they also see one up in the northwest of the property as well. Teck is super excited about drilling this. We have been told by them at recent update, they're going to have permits, likely have permits to drill this thing in the not too distant future. So there's 3 drill programs for one little dinky company that's highly undervalued right now. So in my view. All right. So that's, I think that's it. Go to the next slide. Okay, I went a little bit over, but there you go, guys.
All right, thanks, Quentin. If anyone is interested in learning more about our strategies, we encourage you to reach out to Merrick, and his contact information is right here. Look, we have some exciting things going on under the hood in our portfolios. It's been a frustrating, last couple of years, even on the entire exploration front. But we have gold breaking out, and running to new all-time highs. We got silver perking up. The bigger producers are making money in this environment, starting to flow down to the cash flow, to the bottom line, and we think there's an M&A cycle coming. Where's the value opportunity? It's in the exploration segment. That's where, yes, the companies have been starved of capital for a long time, but at Crescat, we've been getting the capital to those companies to do the drilling, to make the discoveries. And in the process of the last 3 years, we have created a large number of discoveries. Yeah, there's been some disappointments, but we have more than our fair share of discoveries, thanks to Quentin and his expertise and knowing where to direct the money, helping the companies to do the targeting. And that's what we've been doing. So we have a portfolio of some incredible discoveries, as well as incipient discoveries. We had a bunch of companies that have been unsuccessful too. That's the way drilling is. But they still have some great targets. And look at what Quentin just said about Condor. We finally got the permits to drill Pucamayao last season, and they found some gold. It was, it wasn't anything big, but now we got the bigger permits on the bigger area. 3 other targets. I mean, this is what it's about. You keep after the good targets, and but the money is we believe it will be flowing into this industry, because this is where the catch up needs to come. Is gold's already breaking out, silver's already breaking out. Do you want to just buy gold and silver, or do you want to buy the companies that have the gold and silver in the ground, that are going to be the next mines, because they're the high grade economic mines that the world needs for the stuff like all the solar energy infrastructure that we're building out. The world doesn't have the silver to meet the demand that the EIA and has just shown us that we're going to need. We got the silver in our portfolio. We've got it. Talk to Merrick if you want to learn more. That's all I've got for today. Tavi, any final comments?
No, if you are interested in learning more about Crescat, I'd suggest you to talk to Merrick. The phone number is on the screen. You can also contact him on the email address as well on the screen. If you like these videos, please subscribe to this channel. You can find that on YouTube. Just type Crescat Capital and you can find that. And I suggest you to there's a few suggestions I can make in this video. One of them is to follow the Crescat channel, so you can get notified of our upcoming videos if you're interested in those. Also, we will be posting a letter, hopefully over the weekend or very soon, in which Kevin is doing, I should say, almost entire work on that one. So be on the lookout for that. That it should be coming very soon. All right. Well, thanks everybody for watching, and we'll be back next week. Thank you.